As the week winds off, traders say an anticipated cash reserve requirement debit is expected to further drain liquidity in the system, while the results of the central bank's SMIS auction is expected today. Ladi Belo is a fixed income dealer at Access Bank. He joins me now for more on the markets here in Nigeria. Thank you so much for your time today, Ladi. And let's get into what we're seeing play out on the markets here. What has the sentiments been like so far this week?
Hi, good afternoon, Kenneth. Thank you for having me. Well, this week it's been a week full of mixed sentiments. We've seen bearish sentiments in the market as well as bullish sentiments towards the end of this week. The bullish sentiments have been sustained on the back of excess liquidity in the market, as well as some of the coupon payments that have been made on the 2028 maturity. Going in towards the tail end of the week, which is yesterday and today, we've seen bids inch up in our market, especially within the bond space, as counterparties or local players begin to become a little bit more cautious with their trading as we approach the beginning of the new month.
All right, but with those cash reserve requirement debits expected, how do you think this is going to impact the outlook for the liquidity going into next week?
Okay, well, where we stood at opening the markets yesterday was around 600 billion. This was depleted by the OMO sale of about 325 billion. So as it stands, we should be roughly around the 300 billion mark. Right now, there's been no indication of CRR debit, simply because the level of liquidity in the system is not that heightened. It's not at a point that we've seen it in the past. Nevertheless, we expect at some point for the CBN to come in and intervene to take this liquidity in the system, either in the form of a CRR or in the form of an OMO sale in the market. So by and large, we expect OBB and overnight to increase marginally. They were at 7.6 and 8.3% respectively. So we might be at double digits before the day runs out.
All right, but what about the participation of foreign portfolio investors in the market? Are we seeing that increase since we saw that bull run from the bond space?
Okay, so what we've seen last year was a bullish run coming from about 14% all the way to about 8% yield, especially on the long end of the bond curve. This represented quite a significant basis points drop over the time frame. And as of now, because of the situation on the FX side, i.e. The inability to deliver the funds when necessary, repatriation of funds has become increasingly difficult. The liquidity in the INE window has been sustained, as well as the OMO rates at about 10.1% levels on the long end of the curve. When we compare this to the level of inflation at the moment, you're seeing negative real returns. Your earnings on your portfolio would seem to be negative, but this is not what the FX guys look at. The offshore guys look at the carry trade. That is where or by how much they can stretch their naira in the market. So up until the stability in the FX window happens and the OMO rate continues to inch upwards, we continue to see a little bit of just a bit of participation from the offshore guys. We wouldn't see that much activity from them up until we see heightened liquidity in the FX space, as well as incrementing rates across board, be it on the OMO and as well as the FGN yield curve.
All right, but Ladi, let's look at the story I just read earlier on the finance minister and that delay in the 1.5 billion World Bank loan, the World Bank raising concerns around the disparity between the official rate and the parallel market rates there. For you though, how much further do you think we can see that narrow down?
Naturally, given the climate of the economy and what's going on around the globe, we'll see an inability to raise foreign debt. So what MO has come in to say over the past couple of days would be their intention to convert some of the foreign debt to local debt. So what we expect to see is going into March for the supply of bonds to increase, which would also push rates further up in our market. Probably would also increase the participation of offshore counterparties in our markets as well. So by and large, the bullish trend that we've seen over the last couple of trading sessions will be tapered down a little bit as yields would continue to go upward because of the pressure that the government has to raise funds at this current time.
All right, then, Ladi, definitely quite a lot to look up into the market going to next week. We'll definitely keep our eyes and see how the markets are performing. Ladi Belo is a fixed income dealer at Access Bank.